show the screen, and in front of you actually, everyone, you can see the 5 minute of the S&P future. Right, okay, so I'll now hand you, Rita's not here yet, she'll be here later probably, but I'll hand you over to Tom. Tom?
Yeah, thank you very much, Peter. Hi everybody, Tom Williams here, speaking to you from Worthing. South coast of England, as you all know, about 40-50 miles south of London. The weather's warming up, thank goodness, and everything seems fine. Okay, so now your clocks went forward. Is that right, Peter? You moved ahead 1 hour, we haven't. Now, I don't know why they don't get together and do it all over the world, moving these clocks around. America, well, America is so vast, she can do what she likes, I suppose. Everybody else follows. But even so. But we weren't quite sure whether there'd be many people listening, but apparently there's 30 to 40 listening already at the moment. Anyway, welcome you all, whatever time it is. And we've got a 5 minute chart up on the screen. It looks a bit weak, doesn't it, at the moment? 5 minute chart now. Okay, so let's look at the background first. Now we had a big down move here. Now that big down move was caused through this look. Right. What's that say, Pete? That says supply. Fair enough. Okay, the market's not there to help you. It's there to confuse you and to encourage you to lose money. Right? So they have this nice up move here to convince everybody that that's not weak, it's strong. What's that say, Peter? That says supply, right, which is true. Now, okay, the market then falls. There's a blue bar. There's a... Oh, it's updated. Sorry, it just updated. And it threw the cursor to the leading edge of the chart. Right, okay, it's a little bit of supply on there, look. Now, this is interesting. This is a failed test, look. It went down, closed near the high. Does that say test, Pete? It says a test, which it is. However, if you look at the volume, it's too high. And, right, you're not fooled, really, because you've got 1, serious sign of weakness, 2, and even these bars here, they're not strong bars. So it's no surprise when that test fails. So it's what we call a failed test, right? Any weak market, when you see these blue up bars with weakness all behind you, look at the low volume, no demand. Professionals know it's weak, and they're not participating. Now we've got multiple arrows here coming in. So there's some buying here at the bottom, look. That says strength coming in. Right, strength coming in. What's that one? No supply test. Yeah, well, no supply means that it's a narrow spread down, look. The low is in fresh, what we call fresh low ground. Right, and the volume is low. Right, there is no supply. That's what the professional money see. So they jump on the wagon and start buying here, look. And then they reverse it round. That's where the trading system kicks in, look. All the time it's blue, it's going up. Right, reaches some supply here. No demand. There's an arrow there, look.
No demand. One before was probably supply. Supply coming in.
Right, so we've got supply coming in. Professionals see that, but buoyantly they still market it up. No demand, no demand. That's kind of interesting, really. I know it's easy in hindsight to pick all this stuff out. The difficulty, I suppose, is to believe what you see as it's running live. But that's part of your learning skill as a trader, which will come as if you keep persevering. Widespread down, followed by an up move. No demand, is it? Right, okay. It's only 5 minutes to update it again, right? It's 5 minutes, is it?
Yeah. Oh, no, it's changed.
Yeah, I thought it had.
Hang on.
Is that it?
Yeah.
Now, what's sort of, I realize you probably never spot this when it's running live, but here we got a sign of strength appear.
No supply.
No supply. Now, the professionals would know that. And what's important is, it's at that level. There is no supply, right? We would like to see that tested. However, the market still fell a couple of bars, look, and they're busy buying because they've seen that no supply there, right? Now, what we'd like is a test. And lo and behold, there's a test. They're lost within the chart, look, but they've marked it down here, look, on that level, look. The levels are important because the biggest danger to professional people is that once they go long, right, is other professionals or other people. I'll just put that back. See, apparently when it updates, so you've got the first sign of strength came in here. Professionals saw that. Next 2 bars they were buying, right? And then we'd like to see a test. Now, obviously, that's admittedly a blue bar, but if you looked at a shorter time frame, it obviously went down to that level. It's the level that's important, right? No supply. So up it goes. However, it's hitting supply now, look. Supply, no demand. And that's why it's come off, look. It's come off because of this. No demand, right? We saw this. No demand. And supply, look. Right, so there's a supply. Professional money saw that. It's so buoyant, they still mark it up. Look, no demand, no demand. That'll be no demand there. That'll be no demand. When you start seeing these up bars like this, when it starts telling you there's no demand, of course there's no demand there because the professionals see this weakness here. They participated in this, probably supply and no demand. So every time it's marked up, which they can do, right, the main serious traders aren't participating. And that's why we get no demand, sign of weakness. And that's why it's come off there. Still looks a bit dodgy for the upside. I suppose if you're real keen, can you draw a Fibonacci 50% retracement, Peter? Eh? Low and the high. low. This is a 50% retracement. It's about the only mathematical formula that I've ever looked at. %. Oh yeah, so we've dropped below the 50% retracement. That shows, the fact is it's dropped below that line, right, where you expect some support. Shows there is moderate amount of weakness in this chart. If it was really strong, it wouldn't drop below this 50% retracement, or should we say unlikely to.
Tom, ask the question. So we've got a question here from B. Roman, who is asking, what are the green and red triangles telling us?
Well, the red triangles are showing weakness. The green green ones are showing strength. Put the cursor over the green or red arrow and press F1. And there's a dialog box there that more or less tells you what we tell you. We don't hold any secrets. There are no secrets in the stock market. There's too many clever people out there. There's no secret formula. There's nothing. Right? And this is how these top traders trade. They trade on the forces of supply and demand. And how that's created, because professional money, like on the low here, when you go back to the lows here, right, we can see when the buying first started, we saw it right there, look, here, right, and it was tested. Now the reason why professional money went in here, sorry, it keeps updating, is that behind you, you have a substantial fall. In other words, the market becomes vulnerable to one or more groups, professional people. Now, when we talk about professional, we're talking about traders with 50,000 contracts, which would make the normal person shudder, right? But when you get these large blocks going in like this, what it does, it bullies the market, it forces the market, right, into a change of direction. And that's all these signals we're looking at. Now green one, look.
Strength.
Yeah, strength coming in. So you put the cursor over the green arrow, press F1, and it'll give you at least what we know about the market. And if you persevere and keep studying this, you'll be surprised how clever you get at analyzing these things.
So Edmund in the room is pointing out that on this chart package, towards the bottom right hand corner, there's a little countdown clock that shows when the bar is coming to an end. In other words, when it gets to 000 on that particular time frame, the next bar will start. So I don't know what other packages do. I use this myself, this version of the software, so I haven't really paid attention on other packages. I expect other ones to do something similar, I don't know. Just handy to have that there. So that's that one. And while we're still on this chart, it's a general question actually from Robert. Tom, are you listening, Tom?
Yeah.
Would you please explain what does probe of supply mean? Seb Manby often uses this term, explaining how an up move is expanding.
Well, it's like any other profession. You know, if you suddenly want to become an airline pilot, you've got to start talking their language. And you've heard them, you know, the way they talk about which runway and all this stuff. It's the same thing with the stock market. When we talk about a probe, what it is a test. And that's what it is actually. But if the market is particularly strong, they don't have to probe down too far. And that's why whenever you see it seems to be happening quite often recently, you get a red arrow like no demand, and the very next bar there's a red down bar, what we call a test. Very powerful indication the market wants to go up. And see that you could describe it as a probe down. And that's what they mean by probe down, looking for supply. Of course, the extreme version of that is a shakeout, where they really ram it down. If some so-called bad news appears, it's not the news that's doing it. I mean, you think logically about it, it's fairly obvious what goes on. I mean, trouble in Georgia, of course, wherever it is, the Crimea, right? Some sort of news comes out the Russians have sent in troops. Now, what on earth has that got to do with our stock market? Highly unlikely that it's going to damage the stock market at that moment, but they use that news to ram it down as if something fearful is happening. And so that's what professionals do. So listen to the news by all means, but don't listen to the news itself. You read the chart and realize that professional money will whip the market up and down on news. And so if they have a nice shakeout on that, you could call that a probe down. And what it really is, looking for supply, trying to catch stops, and mislead as many traders as possible. This tends to create like a vacuum and sucks the market back up higher, and it's a ploy for higher prices.
Okay, thanks, Tom. On that very question, Carlos is asking, Tom, can unexpected events like earthquakes or wars take the smart money by surprise and make them change their positions in the market, or perhaps close positions even at a loss?
Well, there are professionals who do lose money. But normally they know, they're a clever lot, and they have people, fundamental people, look at all this stuff, and they certainly wouldn't be caught by surprise with a war or something. Now, the only thing that might cause that is, but even there, you know, if the President of the United States suddenly got assassinated, which has happened many times in the past, as you know, the market will be plummeted down, marked down hundreds of points. But I mean, I was on the scene when President Kennedy was assassinated, and that's what they did. If you pick the phone up, they didn't answer it. So you can't do any trading anyway. They won't answer the phones. They just say, well, we can't trade now because we don't know what's going on. So usually they're so well informed and they're so on the ball, shall we say, that the majority are unlikely to be caught. But you do get a few professionals that occasionally lose money. Understandable, I suppose.
And another question from B. Roman. Are you ready, Tom? This is a longer one than normal. This is B. Roman speaking now, I am not aware of the internal algorithms of VSA, but would like to see the following indicator included in VSA. And this would be volume divergence, in other words, volume versus price. It should give a clearer sign of a pivot point. A green indicator when buying volume rises, as price goes down, and a red indicator when selling volume rises as price goes up. It is harder to get a sense of weakness or strength. What do you say to that?
Well, you've got to be, it may sound great in theory on a piece of paper, but I looked at all that stuff years ago, and it just doesn't work because the market's shooting around. You'd have signals all over the place. You get so many, you wouldn't even bother to look at them in the end. But what the closest we've got to that is bearish volume and bullish volume. And that's what that red thermometer on the side is supposed to do. The only thing wrong with it is that one. The only thing wrong with it, it's averaged, but only 2 or 3 bars. But even so, I don't like anything that's averaged. But when I designed that, I didn't have much option. It was some years ago, but I have designed a new thermometer. It's up to Gavin to get it out. And it's very, very accurate. And see, bullish volume is expanding volume on up bars while decreasing on down bars. Now that you can get your teeth into, because it means that if the volume reduces on down bars, it means there's no selling pressure. Professionals are not busy selling, therefore the market's still bullish. Now bearish volume is the opposite, expanding volume on down bars while decreasing on up bars. And that's useful because that's what gives us no demand, gives us up thrust, all these signs of weakness which go on. Now that you can get your teeth into. But what you're suggesting would be a nightmare. It just wouldn't work. Not with a computer. It sounds good. I looked into that and studied that for months on end. And all it would do would give you a pile of signals. You get so fed up with looking at these signals that you would just overlook them in the end. That makes sense.
Tom says, does that make sense? I think B. Roman may reply to that, but let's now look at the currency futures. First of all, the pound, if I can find it, or get it. Yeah, this is a request. Lewis has been waiting patiently for this. No, this is an hour of the pound. B. Roman says, yes, it does. It is clear. Thank you very much, Tom. So this is a pound of the future pound 1 hour, as requested by Lewis.
Right. Well, from my point of view, obviously you've got a fantastic up thrust here. Look. What's that say, Peter? Up thrust. Funny enough, what Peter says. Yeah, it was obviously an up thrust, isn't it? Right. The very next bar, though it's up on reduced volume, look. So that doesn't look healthy for higher prices with the pound. Now, here, see, markets don't like this high volume on these up bars. Up bars here in this program are colored blue. And look, that massive volume as it tries to go up. Well, it's an hour chart, admittedly, but there's weakness there. And that's an attempt to go up, highlighted here. This market at the moment looks weak. But it doesn't mean to say, but you just have to read it as it unfolds. what we're really looking for is a decent test and not this high volume on these blue up bars. Anything else? Yeah.
So Lewis also asked to look at the euro. So 6B is the pound. So I'm just going to make a wild guess. I don't trade the currencies myself currently, certainly not the futures. And I'm going to guess and say 6E is the euro. Am I right, Lewis? If I'm right, perhaps let me know. So I think that's the euro, Tom. 1 hour.
Well, right. Now here we can immediately see there's too much volume up here. Now, what's SAP? That says potential buying levels. Right. And the supply in that previous bar too, look. What? Supply. Now, markets do not like ultra-high volume on these up bars, and that's what produces these signals. As I always say to Gavin, ignore the signals at your peril. Now, the reason why I say that, as you get quite clever and good at analyzing these charts, I've even known one guy to turn the signals off. You could turn them off, you know. He was so cocky that he could turn them off. But you have to be very cagey. If a signal appears, it's there for a reason. And if you see a red signal, and I would say to you right now, you certainly wouldn't want to go long on that euro at the moment. What you need to do, see, this is more the sort of thing you need to see. These down bars, look. Now, unfortunately, there's no signal on this, but it's down to fresh low ground, and there's no selling pressure. And there was some buying way back here. Now that really, of course, is what we call a setup for higher prices. Sorry, I'll move it back, keeps updating live. So there you are, the signs of strength have come in here, look. Potential climactic action. Yeah, right, and there's another one there. Shakeout. Now, okay, so we assume professional money stepped in and bought. Now, if you draw a line across there, you know, where these signals appear, you would normally expect to see a test of that level. It's the level that's important. The cursor's not working, Peter. Pete. Oh, it's back there, sorry. Okay, yeah, so you would normally expect a test of that level if it was bullish. So it starts to go up. However, it's marked by little no demands, signals. It tends to be rounding over, look. But that's what you're expecting because of this in the background. Right? And then lo and behold, there's a down bar. And the volume relative to this is very, very low. And when you get low volume, look, at or near that level, look, it means that there's the supply, which is represented here, look, with this high volume. There is supply there, but they're absorbing it, but you don't know that at this stage. Now over here, they marked it down to that level, look, and there's no supply. And that's why it went up, look. It's as simple as that. Markets work on the balance of supply and demand. If there's no supply, it means the market must be bullish. Now we've got a little bit of, what's this, no demand or something?
Probably supply coming in.
Supply, right.
Followed by no demand.
Yeah, and no demand.
Yeah.
Well, that's professional money. You've seen this increase in volume, which doesn't look much because it's before the markets really get going. Right, so, but however, they have tested it, look. And there's a test, look. There's no signal, unfortunately, on it, on this time frame. But that's down, look. Is that a narrow spread? Relatively speaking.
Volume is the increase.
Yeah, okay. But is this a test, look? In other words, that is a probe down to find out if it's safe to let this market go up. And because of the low volume, the narrow spread also tells you that there's no pressure. And it's closed near the high of the bar, look. So when it went down there, there's no selling pressure from other professionals. So they let it go, bang, up. However, it does hit supply up the top here.
That's potential buying clients.
Yeah, which is a sign of weakness. Okay.
Okay, thank you, Tom. So now there's a question coming here for, or from rather, Simon. Simon wants us to look at the FTSE 100, which unfortunately, Simon, we can't. We don't have the data for that. But we can look at the daily for GLD, as you've requested. Let's have a look. Well, GLD is, I suppose you could call it a derivative of gold. It's what they call a ETF, electronically, I can't think now, GLD, electronically traded fund, but it's essentially a derivative or linked. So, what do you think of that? Now we could look at that, or we could actually take a peek later, perhaps we might return to it, at the gold contract, which usually looks a bit clearer. This is a bit odd looking, don't you think, Tom, or not?
It is, isn't it? There was supply there on that bar. I'm a bit wary of these type of markets. They've marked that up, look, but it's pretty obvious that there's too much supply. Look, the volume's too high. The spread is narrow. That's almost like the end of a rising market signal, right? Almost, but it's not. It's immediately tested, look. Here. Which I just said to you, that if you ever see a test, a probe down, after you've seen a sign of weakness. Now, unfortunately, there's no, can't get this thing to work. Oh, there it goes. They marked it up, look. Right, but there's definitely a test there. Whenever you see a test, immediately after what appears to be a sign of weakness. Now, you might say, well, how can that be weakness? Because it's been gapped up, and look at the high volume. I'm surprised there's no arrow on that. But there you are. I suppose the computer can't pick it all up. The variations are so immense. But you normally would see that. And I would notice that straight away. But then you see the test immediately. Professional money saw that, and they immediately follow with a test look. That means it wants to go up. So let it run a bit. There's another test look, a probe down. Right. The volume is a little bit, it's not exactly high, but it's not exactly low either. However, it's obviously enough to let that market go up. Now, the main thing is that we're going to have a test.
So while you were talking, Tom, Edmund said that this, in fact, Ramaya said actually this is not electronically traded fund, as I said, it's exchange traded fund. So thanks for that correction. Edmund says that the reason, sounds quite plausible, the reason why the gaps are here is because this market is traded only during the American market hours. So that means, therefore, as gold is probably traded at other times, I have no idea, it might give a different picture. So let's just update the end of day chart so we can look at the gold contract while Tom considers a question from Simon. Tom, do you ever use point and figure to estimate targets?
Well, I know all about point and figure, but unfortunately we don't have anything in the program that I can use. I used to do them all by hand for years and years when I worked for the syndicate. And you take account once the move starts. And if you look at a stock, which most of our trading was, well, it was the only thing available. One of the only things available is that you get the preliminary support where you see them moving in, professional money. Then it oscillates around almost like a crankshaft, moving up and down, going around. Oh, Risa's here, good. Right. And then when the stock's ready to move, it'll dip down to that same level where you first saw the preliminary support, and you take your count across there. And you take these counts, and very often you think, ooh, I don't think it'll go there. But it always does. So they definitely work. But I can't demonstrate that because I don't have a point figure on here. That's something that Gavin's got to get developed somehow. I'm not a programmer, unfortunately, and I'm relying on other programmers. But I've employed 8 programmers the last 10 years or so, and they come and they're very clever, intelligent people, very pleasant, and they busy work away, but nothing really materializes because most of them, although they're clever, they don't understand what they're looking at. They're not traders. However, we do have a gentleman in Moscow called Gregory who now trades this, and he's a very clever programmer. So we are getting the grips, and he's getting the grips with a few things. But that's point figures, very good. But we don't have it here.
Okay, Tom. Thanks, Tom. This chart in front of you is the gold contract. Now, I really don't have any idea how it all comes together, but it looks like a different chart to some extent. I mean, in general, it's the same. It's going up. But, of course, there are no huge gaps like on the other chart for GLD. And why that is not clear to me, because gold, as far as I know, may be traded all throughout the days and hours, but I know there's a lot of fixing goes on. I don't mean that in a negative sense, although perhaps it is anyway. A lot of fixing hours occur, I think, in London, so it's a mystery to me. However, do you want to comment on that chart, Tom?
Well, of course, the previous chart, they're only showing the hours where they actually traded it, and that's why you get all those gaps, which is, you could read them. There's still a lot of information there. But this is apparently a gold chart we're looking at the moment. And it's trending up, heavily trending up, isn't it? Look, it's following the trend lines. And the little bit of supply on that bar there, admittedly, but that could be because it's pushing through these old tops, look. That could easily still be bullish, even though it's a very narrow spread. Up bar, look. But certainly trending up, look. That's a test, look. Okay.
Okay, now as a general question again, this is from Carlos. Tom, did the fund or group that you used to work for ever lose money on a campaign?
No, they didn't. It's the way they trade these things. They accumulate what they call the floating supply. And it's a different type of trading that we're used to, because they remove from the market the reason why. See, what stops an up move is people selling into the up move. But if you remove most of the floating supply, there is no selling available. And it's you need a lot of money, or that's why they have syndicates. Like Lloyd's in London, you have syndicates, the insurance people, and the reason is it spreads the risk, spreads the monies, and but they're very, very powerful once you get going. And they made money, all right, don't worry. And they kept most of it secret. They don't like people knowing what they're doing. Any questions?
Hello everybody, I've just arrived and now Peter's left the room and I'm trying to pick up on screen what's going on here. Have you done DDD, Tom? Have you done DDD? Edmund, may I ask for your analysis on DDD? Have you, Tom?
No.
Right.
What's that, stop?
Let's... Oh, yeah, you did?
Yeah. This reason's gapped up. They only show you the trading hours.
Yeah. Peter, can you come back, because I don't understand what you've done and what you haven't done. I'll do that. Yeah. Because there's things on there that you've done and you know, it's not on the screen.
Yeah, we looked at that.
Sorry, Peter's coming back.
Cheers. Yeah, we've done that.
So you've done DDD, yeah?
Yeah.
No. So Peter back. Can we look at DDD for Edmund?
No, not this one.
That one there.
Oh, that's different. This one?
Yeah, that's a daily chart of DDD, and it's a stock, I imagine.
Well, I can immediately see it's weak. This is clearly a distribution area, look. If you're writing a book, this is what you'd show as a weak distribution area. Right? Market moves in, up it goes, look. Note it's a spread. Narrow spread. Close in the middle. Next bar down is a serious sign of weakness. After you've seen an up move. Now the up move makes the market vulnerable to professional money selling in there somewhere. Now we may not have a signal on there, but they'd be selling all right. It's gap down, right? The market moves sideways as they support it. And then they think, right, okay, we're going to have a nice up thrust here. We're going to catch loads of stops. What does it say? Up thrust. Right. Read these dialog boxes, please. Right, okay, so that's a very clear sign of weakness. When you ever see that, you can short those. And the reason why you can short that is because you've got this sign of weakness here. Up bar, look, narrow spread, after an up move, gap down. They hold the market up for as long as possible. Then they have an up thrust, catch stops, mislead as many people as possible. Don't forget, on these actively traded stocks, there'd be thousands and thousands of stops. They know where they are. They have screens that tell them where they are. So it falls on that. Another up thrust, and off it comes. And there appears to be a little bit of support here coming in on these bars. But remember, the principle is that you need to see this arc over a bit, and then come down to these levels and test if it's bullish, which it may not be. Because professional money and make mistakes as well. But there seems to be buying here, look on these. That's what produced these signals, look. Now, if that is genuine, and it is buying, then you see this market go up a few bars and start mushrooming over. And then when it comes back to this level and tests, if the volume is very low, then that'd be bullish. But this here, look, is clearly a distribution area. You could see that immediately. You don't have to be clever or anything. It's pretty obvious, look. Now, of course, I am admittedly talking in hindsight where you can see all this. But you should train yourself up to be able to spot this.
Okay, thank you, Tom. Question from Simon, and I'm just going to put, in anticipation of the question, put the monthly charts of gold. That's the monthly chart of gold. Now, so this is the question, and it's not about gold, but you'll see what I mean. Simon's asking, for medium and long-term stock trading, does Tom find the monthly and quarterly charts useful, or is there not enough detail in them to judge? And when he said that, the first thing I thought of was gold, because I was interested in gold some years back. And this is a monthly chart of gold, and you can see right at the top there's what's known as, apart from high volume on the up bar on the monthly chart, immediately next bar is down, buying climax, and a top reversal in effect. So of course gold came off after that. So with that as a background, Tom, or as an example, do you find the longer term charts of any use?
Well, you can have a quick, with computers, you can look at these charts in a few seconds, really. I mean, you can, in hindsight, of course, you can clearly see this is what we call a buying climax, right? The market's gone up for God knows for how long here, right? I've got a job to see the chart. Well, I was looking at the top there. I've lost it a bit. Well, in this case, I think we do need, look at that. Wow. Now that's the top of gold. You're not kidding. It's not hidden. It's pretty obvious. High volume, look. Up bar. But the market's vulnerable. Now what's interesting here There's a principle here, whether you're able to spot that. I've mentioned it several times. When you see a red arrow, look, no demand, especially no demand. If the next bar is tested, it's a sign of strength. And there's a test, look. It's a red down bar. Right, it's not an ideal test, but it's certainly a test, look. Volume's lowish, spread is narrow, and the next bar's up. That means you're going to get higher prices, which worked out. And the same here, look. There's no red arrow here, but these are tests, look. But this is supply. Look at the volume. Imagine now, right, the market's vulnerable. In other words, it's gone up. This is a top reversal. Okay, immediately followed by no demand, look. Of course there's no demand. Professionals have seen the market go up on that bull move. They've seen the top reversal. It's been marked up at the moment. No demand. Professional man say, well, you do what you like, mate. I'm sitting still. I'm not trading this. The same thing here, look. It's another up thrust. Now, it's surprising how these things work on a monthly chart as well as a 5-minute chart. But that's it. It does.
Okay, Tom, thank you. While we're here, we've got a request for crude oil. So this was John asking for this. So this is crude oil. There you go.
Right, crude oil. Well, immediately we can see the reason why this market's fallen. I know it's dead easy in hindsight to see this stuff. But there you are. This is a top reversal, look. At a point where you wouldn't want a top reversal. See, so the computer spotted it. And that's why you've got this widespread down, next bar. That's what Gavin calls a gotcha bar, to catch as many traders as possible by leaving them long all those traders that bought in this area top it, right? Because human beings, they don't like to buy back into a market or sell, I should say, when the prices the previous day or two were higher. Because now they're thinking, oh, I don't like this, I'm going to get out. They know that. So the market goes up on no demand, look. That's clearly, there's no signal there, but that is no demand, look. Look at the low volume. Look at the narrow spread. And the main thing is this, look. This is hovering over you. That's what influenced you, and recognizing that there's no demand there. And off it goes. There's no indication at the moment of that going up at all.
So does that mean we can all expect lower prices at the gas pumps? We don't know, do we? What do we all think? Okay, so now what have we got here? This is a question. All right, I'll just answer this question from. Are you Jan or Jan? My internet wasn't working. Where can I see the recording? Well, the recording will be going up later today, and you can find it via the VSA Club archives. So log into the VSA Club, and go to archives, and you'll find Tom's archive near or at the top, providing it all works out. Okay, there's a question here about point and figure from Julius. Tom, you say you count point and figure. What exactly are you counting, and how does that tell you how far the move will be?
Well, a very good scientific question. All I know is that they work. You could describe it roughly. Let's say you go to work on a regular route every day, and there's a field that you pass. And one day you see a couple of guys there with a wheelbarrow digging a hole. Now, you know nothing much is going to happen. Two guys in a wheelbarrow. But say you go by next day and there's suddenly huge cranes, big diggers, 50 guys all with crash helmets on, the whole works. Then you know that there's something big going to happen. Now the point figure are very similar. With a big move, you do have to have an accumulation area. And it's pretty obvious on a point figure. Well, it's not obvious. What's obvious is a chart, but then you relate that information to the point figure. And you don't have to worry about taking account until the move actually starts. And that can be normally spotted. The first point of support, it zigzags sideways as they do what they have to do. Then you get a test at the same level as the first point of support you saw. And that's why very often you see in these charts, you see a green arrow, the next 2 or 3 bars are still down. And that's because they may have bought something there, but they're not ready yet. They zigzag sideways. But that's really, point figures are great, but you can't beat reading the bars. You could sit here, in a few seconds you could see what charts more or less strong or weak. And then if you're interested, you give them more detailed examination. But that's, look, a top reversal there. That's a sign of weakness. There's a top reversal. No demand, nothing. Where's the stopping volume? Nothing much happening at the moment.
Okay, final chart is going to be silver contract. This is silver as requested by Ramia. So, Tom, what do you think of that? Interestingly, it's not exactly like gold. Often it follows gold around or vice versa, but anyway.
Well, nothing particularly. Can you put a few more bars on, Peter? Oh, that's better, yeah. Well, you can see there was an up move here. Right, so the market becomes vulnerable. And of course it's overbought. There's a high volume coming in. Markets don't like high volume on these up bars. What's that?
It says overcoming market.
It's true, it was. In fact, it made that market roll over, though. There's nothing obvious that I can see on this chart, except you've got that weakness in the background. And when it goes over the top of that trend line, it's actually overbought. It doesn't look particularly clever, that trend line, but it's still a trend line, must be drawn somewhere properly in the background. If it goes over that, it's overbought. which makes it vulnerable to come off. But you've got weakness here. This high volume here, look. This is what did the damage here, look. On this up bar. And that's why you got this signal. Supply. Which is true. You get side of strength. All that produces is a few up thrusts, few no demand bars. To me, that doesn't look very strong at all. I certainly would be interested alongside of that.
Okay, folks, we're out of time now. If we didn't answer all your questions, which we haven't, you might want to go and listen or watch Gavin, who I think is on later. You could come back next week, of course, and ask the same question or pose it on the VSA Club forum. Just one question here has come up. Are you starting at 4:30 UK time now from Gordon? Well, yes, for a few weeks until the clocks synchronise again. But it's as per the timing on the VSA Club, just so you know. I think that's it then. So we're doing a newsletter this week on what day? Sunday, as usual, or almost as usual. And we look forward to seeing you all next week. So thanks very much for coming along and listening to Tom, and we'll see you all again soon. So with that, goodbye.